Pleased to be joined now by Hayman Capital Advisors, Kyle Bass, joining us from Dallas. Kyle, listen, you got the People's National Congress, which is kicked off in China, an incredibly important event laying out a bunch of things, but including their economic plans here. Do you still remain concerned about China? Do you think that a trade deal is going to solve our, quote, problems with that country?
You know, I mean, Brian, I like the way you set me up with the question. You know, I don't believe a trade deal will solve any of the problems between our two countries. You know, we have a golden opportunity today for a global reset in our relationship with China. Trade is such a small part of our relationship there, and you know, yeah, we run a $400 billion a year trade deficit with China, which, you know, as the global hegemonic currency and reserve currency, we must run deficits with the world to supply the world with dollars. Now, the magnitude of those deficits can come into question, but with China, you know, our real issue is forced technology transfer, it's intellectual property theft, it's industrial, subversive industrial policies that, let's say, circumvent WTO rules. It's basically the way the Chinese lie, cheat, and steal their way through our economy. We basically have no we have no way to truly measure and/or counteract those things that actually have huge returns on investment for them and massive negative returns on investment for us.
But the reason that I asked that question coming in, sort of knowing perhaps a bit of your answer, Kyle, was this. From what we know of that deal, and again, this is all reporting, right? So we haven't seen the actual structure of the deal, that there will be more IP protections for U.S. companies in any kind of a deal. The U.S. government, Section 301, large report, they have mandated this. Sounds like you don't believe those protections are going to be strong enough if and when they are completed.
I think that there's more of a desire amongst the administration to hear the Chinese admit to the enormity of intellectual property theft that they've engaged in over the last 10 years. You know, our own government, whether you're looking at the Defense Department or whether you're looking at the trade reps reports to the White House, they all estimate that number is $200 to $300 billion worth of IP per year. And right, there's a return on that annually as well. So over the last decade, they've stolen, you know, 2 to 3 trillion in IP from us. And really, the U.S.'s #1 asset, in my view, is our ingenuity, our intellectual property, our ability to innovate.
Yeah, and something like 75 to 80% of the S&P's intrinsic value is intangible assets, is ideas,
yeah,
is patents.
That's our game, and they're stealing our game from us. And so it's really important for this new agreement, whatever it is, to be measurable and punishable. And I think those are the things that hopefully our team's working through. You know, I know the various constituents of our negotiating team, I know many of them, and they all have their heads in the right place. They're all doing the right things for our country. The big question is, which side of the bed does our fearless leader wake up on the day in which that meeting happens with President Xi?
Listen, we can make a deal. It can have all kinds of legal protections. If China or its companies continue to do what they have been doing, then the deal is just only as good as it is on paper. Do you think U.S. companies and U.S. courts need to be more aggressive in holding Chinese companies accountable?
I mean, of course. And you know, look, there's so many things. There's so many things that our government can do to reciprocate with the Chinese on these issues. You know, why do we have hundreds and hundreds of Confucius Institutes in our educational institutions, in our colleges? Why do we allow Chinese points of presence in our telecom switching facilities when they don't allow any of ours in theirs? You know, there's so many things that are so simple for us to do. We just need to do it. And then on the judicial side of things, we could make a few judicial changes in the U.S. that really make it more difficult for the Chinese to act the way they've been acting with our intellectual property here in the U.S.
Why is the Chinese market up 25% this year?
Well, I mean, the Chinese print more money than any other country's ever printed in gross terms in world history. You know, since 2001, they've printed roughly $30 trillion worth of RMB. Think about that for a second. You know, the debate here in the U.S. at the Fed is the Fed balance sheet too big? Is it too large? You know, it got to $4.5 trillion. Should it be $3.5 trillion? China's printed $30 trillion worth of RMB in a decade. Like, the scale to which they've printed is, again, it's unprecedented. And I think the world's going to see, can the Chinese run their stock market up? Absolutely. Domestically, they control the price, they control the printing press, they control the police, they control the narrative. They can control that for a long time. The way they interact with the rest of the world is they actually have to spend dollars, euros, yen, or pounds for anything that they're trying to import, because nobody will accept wampum as payment, i.e. the yuan or the RMB. And so my view is that at some point in time, economic gravity is going to catch them on the FX reserve side. And it sure looks like with them heading into a current account deficit. By the way, they run a 10% of GDP fiscal deficit. We only run, we're up in arms about running $1 trillion here, which is roughly 4%. They run a 10% fiscal deficit and continue to do so. So I think the economics between our two nations are very, very, very different. And I think that at some point in time, the world's going to see that the emperor has no clothes.
But here's the thing. If you see some sort of economic imbalance, as you did with subprime, you can bet against it in the United States with CDSs, short of stock, whatever it is. The Chinese government makes it nearly impossible to bet against its companies, with the exception of maybe borrowing or shorting some of the Hong Kong listed shares. If people are listening to you right now and believe what you're saying, how do you invest against China? How do you bet on them slowing down?
So we are not, for what it's worth, we're not short Chinese equities for that very reason. I think that the government of China can do whatever they want with equity prices. I think the ultimate arbiter of all of their economic actions will be the exchange rate between their domestically held currency and the rest of the world. And so there are cross rates between that currency and the dollar, the euro, the yen, the pound, the basic large currencies around the world. And I think that exchange rate will end up being the thing that adjusts the most.
And then how do you play that? That seems complicated.
It is complicated. For us hedge fund people, we have to unfortunately get into the forward markets of currencies and the options market of currencies. I think for the general population listening, I think that you need to think really long and hard about investing in equities of a country that has no rule of law, that to the extent that things go south, you as a Westerner in a Chinese bankruptcy, you're not going to own anything. I think that all of the Chinese stocks in Hong Kong, you should just put the word tracking in front of it. You own a Chinese tracking stock. You don't own anything as far as assets, because, again, when things go south, you as the Westerner will be left holding nothing.
Well, MSCI just raised their weighting on their global indexes. They made Chinese stocks 20% from 5%, not a 5 to 7% jump, 5 to 20%.
Yeah, MSCI, I know they were pressured. I don't know if you saw the Journal article about a month ago, but MSCI was pressured heavily by the Chinese government for the initial inclusion when they, let's just say they weren't, given the way that the Chinese have a closed capital account, and if you look at the Chinese purport to have 15% of global GDP at the current exchange rate with the dollar, but if you look at SWIFT, the global currency settlement system, less than 1% of all cross-border SWIFT transactions settle in the Chinese currency. So I don't know how MSCI can give the Chinese equities a 20% weighting when Chinese currency settlement is less than 1% of global currency settlement. It's kind of it makes no sense to me. And in the end, what MSCI is going to be doing here is causing a lot of people many losses when this thing turns south.
Are you betting against the U.S. market in any way, Kyle?
No, I think the U.S. is kind of the tallest midget at this moment in time. When you look at the globe, all the subcomponents of Chinese industrial production, they're kind of, let's say, they're all down except energy, and the consumer in China is actually down the most. When you look across the globe to Europe, you look at Italy entered a recession a few weeks ago. All of the subcomponents of Germany they're actually dropping faster than they did, or as fast as they did in 2008. So it looks to us like Southeast Asia is headed for a recession in 2019. Europe's headed for a recession in 2019, and the U.S., the kind of fiscal impulse from our tax stimulus is going to be wearing off towards the end of 2019, where I think the U.S. will, the world's not going to have a recession and the U.S. is keep growing. So I think you're going to see the U.S. have a minor pullback in 2020. Are
you betting on U.S. stocks?
I'm not. I think given the scenario that I just gave you, what I think is likely to happen is U.S. interest rates are going to head back to zero in 2020.
So you're betting on bonds?
Yeah, I mean, we're long a lot of bonds.
Kyle Bass, Hayman Capital Advisors, a real pleasure to have you on Worldwide Exchange and CNBC. Kyle, as always, thank you.